Today we are going to start a debate style presentation about alternative investment. We will discuss our analysis and insights on alternative investment, focusing on portfolio allocation strategies, projected returns, and the contribution of both traditional and alternative asset classes in achieving financial stability and growth. We have conducted a comprehensive study of each investor risk tolerance, investment goals, and prevailing market trend to design the diversify portfolios to maximize long-term return while managing risk effectively. Now, I will start with my portfolio introduction. I'm Winnie, a 22 years old full-time university student. As a law investor, I aim to balance opportunity with caution in my investment choices. My goal is to increase my revenue while avoiding significant losses, ensuring steady and responsible financial growth. I will present my adjusted investment portfolio and explain my 60-40 allocation to gold and the ASX 200. My main investment objective is long-term stable growth with a focus on risk control and capital preservation. To achieve this, I have allocated 60% of my portfolio to gold and 40% to the ASX 200 index. Gold serves as a hedge against inflation and a haven during crises, while the ASX 200 index provides exposure to Australia's stable market. This portfolio delivers an annualized return of 5.59%, reflecting steady long-term growth. Each standard deviation of 10.60% indicates stability with a minimal fluctuation. The Sharpe ratio of 0.3853 highlights its efficiency in turning risk into reward, and a low correlation coefficient of 0.0993 between gold and the ASX 200 enhanced diversification, reducing overall risk. This balanced strategy aligns with my goal of sustainable growth and strong defense during market volatility.
I'm Darren, a 21 years old full-time university student. As a high-risk tolerance investor, I can afford a high risk to look for high returns and high potential portfolio. My primary goal is to achieve exponential portfolio expansion. I can see the points of Winnie's portfolio, which is looking for the steady returns. But based on my risk tolerance, I construct a portfolio made out of 60% of gold and 40% of SRP using the diameter data from 2018 somewhere. Gold has long been considered as the safe havens asset offers stabilities, while the XRP represents a more speculative, high growth potential cryptocurrency. As a more risk-averse investor, I can afford the risk and volatilities in the markets to gain more profit. Over time, these combinations produce a diversified performance patterns where the gold helps smooth volatilities and SRP contributes the growth during the crypto bull run. The calculated data shows the average return of my adjusted portfolio is 8.97% and the volatility is 48.49%. Besides, it shows a relatively low Sharpe ratio between gold and SRP, which is 0.15. However, it may not be the fully reliable indicators of performance in this context. The volatilities of cryptocurrency is high, but it also means a chance to let the normal people to get rich. And we should focus on the long-term capital growth rather than the short-term risk-adjusted return.
My name is Junyu. I'm a 21-year-old full-time university student with a high risk tolerance. My objective is to pursue strong long-term capital growth through calculated risk while ensuring that not all of my capital is exposed at once. I agree that the Sharpe ratio doesn't tell the full story. That's why I'm choosing the same portfolio as Darren. I'm comfortable taking big swings for big rewards. So I have put 40% of my money into SRP. Its monthly return have jumped 50% to 120%, giving me a real chance to double or triple my investment when crypto release. To keep most of my savings safe, the other 60% goes into gold, which quietly grows about 5% to 7% each year and hardly move month to month. That way, when SRP suddenly drops, gold barely budgets and cushions my losses, and even if crypto cools off, my overall portfolio still inches upward. This mix lets me chase cryptos outside while leaning on gold steady gains to protect my capital.
Hi, I'm Eunice, a second year accounting and finance student. I have a low risk tolerance. My objective is to build a strong financial foundation by balancing opportunities and risks. I plan to establish an emergency fund and begin investing next year without experiencing excessive losses. Compared to the high-risk portfolios constructed by Darren and Jingy, I prefer Winnie's portfolio, which consists of 60% gold and 40% SX 200. Cryptos like XRP are highly unpredictable and relying too much on speculative assets. Like this can result in devastating setbacks. The volatility of XRP, even with the potential for high returns, isn't sustainable in the long run. In contrast, I've allocated a greater portion of my portfolio to gold as well preservation is my primary concern. Gold provides stability, particularly during market downturns, acting as a safeguard in uncertain times. With 60% of my portfolio in gold, I am better positioned to weather global economic shocks, inflationary pressures, and other financial crises. This strategic allocation not only offers stability but also positions my portfolio for potential growth as gold prices often rise during market distress. Gold has a proven history of maintaining value through wars, financial crises, and economic downturns, making it a dependable core holding in any portfolio. Additionally, I've included the ASX 200 in my portfolio. The ASX 200 is a reflection of Australia's stable financial system and resilient economy, which offers security and predictability. Its devices nature is an important aspect for risk management, crucial for long-term growth. Many companies within the ASX 200 also pay reliable dividends, providing a steady income stream. This helps cushion against unpredictable market returns, allowing me to benefit from both capital appreciation and consistent income generation.
My name's Hui Qi. I'm a 23-year-old full-time university student with a moderate risk tolerance. My primary investment objective is to grow my portfolio steadily by balancing risk and return to achieve consistent long-term capital growth without unnecessary volatility. I aim to build a strong and diversified portfolio that performs reliably over time, even though the market ups and downs. Compared to Darren's high risk tolerance and Winnie's low risk tolerance, I allocate 60% to gold and 40% to listed private equity in my portfolio, which balance return without overlooking risk. The weak negative correlation between these two assets about negative 0.062, meaning that when one declines, the other isn't likely to follow, helping balance overall risk. And this portfolio has a Sharpe ratio of 0.52, indicating that I'm achieving a reasonable return for the level of risk I'm taking. This portfolio delivers a solid return of 7.37% with a standard deviation of 13.66%, reflect strong growth with controlled volatility. I chose gold for its robust risk-adjusted return and its ability to stabilize performance in turbulent market. Conversely, listed private equity offers higher returns despite a greater risk, which aligns with my growth objective. This combination suits my moderate risk tolerance and long-term goals. Since we have all introduced our portfolios, let's vote on the best one, and we will review the result later. Also, have you noticed any similarities among our portfolios?
I have realized that both of us allocate 60% gold to our portfolios. I think this may be caused by two main set of drivers. First is about inflation and monetary policy dynamics. Gold serves as an effective hedge against inflation. Persistent inflationary pressures combined with central banks' accommodative monetary policies reduce the opportunity of holding non-yielding assets like gold. Analysts also emphasize that gold historically thrives when real interest rates are negative. The correlation between gold and inflation expectation, as seen in TIP-ETF trends, underscore its role in preserving purchasing power during inflationary regimes. Second, geopolitical and economic uncertainty. Gold statues as a safe haven asset strengthened during geopolitical tensions and economic instability. For example, trade wars such as the US-China tariffs, political shifts like Trump's tariff policy, and global conflicts such as Middle East tensions drive demand for gold as investors seek stability. Gold's low correlation with traditional market further solidifies its role in hedging portfolio risk during crises.
I agree, those characteristics make gold a worthwhile investment. Gold has historically delivered 8 to 9% annual return in AUD terms over the past 50 years. In 2024 alone, gold surged by plus 38% in AUD, clearly outperforming many other asset classes. According to JP Morgan, gold could reach $3,000 per ounce by 2025. Chris, a seasoned proprietary trader with over 20 years of experience across currency, indices, and commodities, shared his insight of the gold market. Following the announcement of US-China tariff talk, gold prices pulled back slightly. Despite this, Chris remained bullish, identifying it as a buying opportunity. Chris suggests buying on dips, confident in the long-term uptrend. For the strategic investor, these putbacks offer valuable entry points as gold remains strong. Additionally, CoinConnect forecasts an average gold price of $4,330 in 2025, with a potential high of $5,109 by December, further supporting the notion that gold has the significant appreciation potential.
Great. Jude and Winnie have well explained the reason we're putting gold into our portfolio. The difference among the 40% of our portfolio. I think the reason for this can be the different risk preference. And according to my risk preference, I would more prefer to choose SRP. The reason I chose SRP into my portfolio is that SRP is one of the leading digital asset designed specifically for fast, low-cost cross-boundary payments and making it a compelling addition to a diversified portfolio. S&P quantitative appears lies on its size, liquidities, and performance profile. It consistently ranks among the top digital assets with daily trading volumes in the low millions and ensuring you can enter or exit the positions without significant hedge. In the past year, S&P price has climbed by several hundred percent, far outpacing the major stock index, even after accounting for its high price swinging about 50 to 60%. Besides, based on this self-calculation, S&P returns correlate only around 0.214 with the S&P 500, and this tend to move independently of the stock market and can help cushion the portfolio loss when the equity fall. On the qualitative side, SRP is built on a decentralized ledgers that finalize payments in under 5 seconds, making this far faster and cheaper than the traditional cross-border systems. And more than 100 banks and payments providers on WipperSnap already use SRPs for on-demand liquidities. And a recent US settlement removed the measures legal uncertainties from asset. Furthermore, regulatory clarity has recently improved, especially after the favorable developments in the US that resolved the long-standing legal uncertainties. And this has significantly strengthened the market's confidence and reduced the perceived risk associated with SRP. It's offer both practical utilities and a long-term strategies balance, making it an excellent pick for what's looking investment portfolio.
I selected the ASX 200 because I'm optimistic about this prospect. Sector rotation is expected in 2025, shifting from banking to mining stocks. This is likely driven by anticipated Chinese economic stimulus and recovering commodity prices, which are vital to Australia's mining sector. With slowing inflation and GDP growth, the Reserve Bank of Australia may consider rate cuts in 2025. Lower rates could support equities by reducing borrowing costs and encouraging investment. However, global trade risks remain. Proposed US tariffs may dampen demand for Australian export, especially in mining, posing a downside risk to the ASX 200. As a low-risk investor, I've allocated 40% of my portfolio to the ASX 200. The index shown signs of recovery, closing at 7,968.20 on April 24, 2025, a 1.5% monthly gain after earlier declines from trade tensions. Analysts forecast 8 to 9% earning growth for the next 12 months, though this may be optimistic given economic uncertainties. The index price to earnings ratio stands at 17.9 above the long-term average of 14.7, indicating elevated valuations and potential speculative risks.
For me, I have a positive expectations for future returns from listed private equity. On the qualitative side, private equity activity is starting to rebound after some previous slowdowns. According to Bain's 2025 report, We are also seeing more retail investors entering private equity market, thanks to recent regulatory changes highlighted by Crane shares, and wealthy investors remain confident about private equity returns, especially in fast-growing sectors like technology. On the quantitative side, the numbers are also very encouraging. Research from FS Investment in 2024 shows that private equity has always outperformed the S&P 500 over periods of 5 to 20 years. And according to BlackRock's 2025 outlook, the private market overall are expected to grow from 13 trillion to 20 trillion dollars by 2030. So based on both market trends and strong historical performance, I expect the value of listed PE investment to appreciate steadily over time. I think that's all about the reason why there are differences among our portfolios. Here's the voting result. It looks like we are all agreed that my portfolio is the best. Thank you for your recognition.
Apart from this alternative investment, we can look for other assets as a part of our portfolio. I think Bitcoin can be another choice to add in the portfolio. Bitcoin's most defined features are its decentralizations and independence, which distinguish it from traditional financial asset. Unlike the fact currencies controlled by governments and central banks, Bitcoins operate on peer-to-peer decentralized network. This ensures that no single entities can manipulate its supply, censor transactions, or alter its monetary policies and making it highly resilient to political and economic interference. Moreover, Bitcoin is fundamentally scarce with its total supply firmly capped at 21 million coins, and this program limits contrast sharply with traditional currencies which can be printed in unlimited quantities, which leads to inflation. Bitcoin's scarcities create a digital form of hard money that becomes increasingly valuable over the time. So as demands grow while the supplies remain fixed. This perspective is increasingly aligned with institutional sentiments. For example, Larry Fink, the CEO of BlackRock, publicly stated in 2024 that Bitcoin is a legitimate financial instrument and even suggests that everyone should consider having it in their portfolio. It shows how Bitcoin shifts from skepticism to mainstream acceptance. When the strategy used wisely, it can enhance the long-term performance and diversifications of your portfolio.
I agree that Bitcoin is one of the potential alternative investments. Bitcoin's price surged from less than $1 in 2012 to over $70,000 by 2024, driven by growing institutional or individual adoption, use as an inflation hedge, and fixed supply scarcity. Notable crashes like the 2018 downturn post-2017 peak and 2022 drop linked to FTX collapse and rising rates highlight its volatility. Despite fluctuation, Bitcoin's sustained growth reflects enduring demand and a decentralized system resistant to centralized interference. The future of Bitcoin is also full of big possibilities. According to Waters, Bitcoin could hit $80,000 to $250,000 by 2025, fueled by pro-crypto regulatory shift under Trump's administration and sustained inflow into Bitcoin ETFs like BlackRock's IBIT and Fidelity's FBTC. Additionally, the April 2024 halving, which cuts the creation of new Bitcoins in half, will likely reduce supply and push prices higher. Finally, lower interest rate could lead people to seek alternatives to traditional saving, further boosting Bitcoin's appeal. Moving forward to 2026, Ryan Brown suggests Bitcoin might climb to $179,000 to $200,000. This jump could happen as pension funds begin investing in Bitcoin's ETF, signaling trust for conservative investors. At the same time, Bitcoin is expected to integrate deeper into traditional financial systems like banking and payments. Clearer rules such as the EU's MICR law will also play a role by reducing risk and making Bitcoin safer to use. Looking ahead to 2030, Bitcoin could rise to between $1.2 million and $1.5 million, driven by network expansion as more individuals and businesses adopt it for everyday transactions. The 2028 halving is expected to further constrain supply. Additionally, companies and governments may begin holding Bitcoins as a reserve asset.
Apart from Bitcoin, I think Berkshire Hathaway Class B share can be another choice. It provides an affordable entry into one of the most successful investment portfolio in history. Over the past 5 years, BRKB has appreciated by 190.67%, demonstrating strong and consistent long-term growth. Investing in Berkshire Hathaway enhances the risk-return trade-off through natural diversification, stable returns, strong management, and a reinvestment-focused strategy. Berkshire Differ's holdings span multiple sectors, such as insurance, energy, manufacturing, and railroads, which help to reduce overall portfolio risk. Additionally, it has a proven track record of outperforming the S&P 500 during market downturns, offering defensive quality without starving growth. Under the leadership of Warren Buffett, Berkshire follows a conservative, value-focused investment strategy supported by massive cash reserve and minimal debt, ensuring financial stability. Unlike many companies, Berkshire does not pay dividends. Instead, it reinvests its profit into the new businesses or stock purchases, allowing for compounding growth over time. According to the Yahoo Finance, Berkshire Hathaway 5-year annualized return has surpassed that of the broader S&P 500 index. Morningstar also rates Berkshire as a well-mode company, indicating strong competitive advantages and lower investment risk. In the conclusion, adding Berkshire Hathaway Class B share to an investment portfolio not only diversifies risk but also ensures stable long-term growth backed by a well-managed and financially robust company.
I agree that Berkshire Hathaway Class B shares is one of the potential alternative investments. Then let's briefly review its market expectations and financial performance. So first, in terms of stock price, analysts are forecasting a large range between 465 and $606, with an average around $512. This suggests a stable and steady growth going forward. Next, on earning growth, the company is going to grow consistently over the next few years with a compound annual growth rate of around 6 to 8%. That's mainly thanks to its well diversified investment and strong risk management. For shareholders' returns, BRKB continues to perform well. The return on equity is expected to stay around 20%, and they have been actively buying back shares, which adds long term value for investors. When it comes to risk management, Berkshire is known for its conservative and flexible strategies. This helps the company stay financially stable even when the broader economy gets a little shaky.
I will be talking about my chosen alternative investment, hard commodities, specifically Rolex watches. In recent years, Rolex timepieces have gained attention not just as luxury accessories, but as valuable investment assets. Rolex watches serve as an excellent hedge against inflation. When inflation rises and the value of money falls, physical assets like Rolex often maintain or increase in value. This helps protect our purchasing power during uncertain economic times. Rolex is a tangible asset. Unlike digital investments or stocks, you actually own a physical item that can be held, stored, or even used. This tangibility provides investors with a greater sense of security and control. Rolex watches have shown strong long-term appreciation in value. Some models, especially limited or iconic ones like the Submariner, have consistently risen in price over time. In many cases, they have even outperformed traditional investment like bonds. Rolex benefits from a combination of luxury demand and scarcity. The company strictly limits production, which makes many models difficult to obtain. This scarcity creates high demand and supports strong resale values in the secondary market. Another key advantage is global liquidity. Rolex watches are well known and highly sought after worldwide. They can be easily sold or traded internationally, often within a few years, making them highly accessible as an investment. Rolex also helps with portfolio diversification. Since it doesn't follow same market patterns as stock or bonds, it can reduce overall portfolio risk and improve financial stability. In conclusion, Rolex and similar hard commodities offer a unique mix of financial and personal value. They combine stability, growth potential, and personal enjoyment, making them a smart and stylish choice for a modern investor. Thank you. That concludes our presentation. Thank you for watching.